The most profitable HEIKEN ASHI smooth price action trading strategy. The HEIKEN ASHI smoothed indicator is a modified version of the regular HEIKEN ASHI candlestick charts. Unlike the regular candlestick chart which shows the open, high, low and close of the price during a session, the HEIKEN ASHI chart takes a different view. When price is trading above the HEIKEN ASHI smoothed indicator, it is said to be bullish. And when price trades below the HEIKEN ASHI smoothed indicator, it is said to be bearish. But the main difference between the regular HEIKEN ASHI indicator and the HEIKEN ASHI smoothed indicator is that the second type of indicator plots the HEIKEN ASHI candlesticks as a moving average. Thus, you can see both the regular candlestick or bar chart alongside the HEIKEN ASHI smoothed indicator. How to use the HEIKEN ASHI smoothed indicator. One of the major rules of using this indicator is in determining the trends in the markets. It is a widely accepted principle that the trends change when you see two or more HEIKEN ASHI smoothed candlestick in the opposite direction or color. This is where traders either prepare to take an entry in the direction of the trend or the color, or they can use this to adjust their stops. Bullish and bearish signals are generated when the moving averages mark a golden cross, or when the short-term moving average cutting across the long-term moving average to the upside, and the death cross, or when the short-term moving average cutting across the long-term moving average to the downside. But as with any trading strategy, using just one indicator will not give you the market perspective. This is the same case with the HEIKEN ASHI smoothed indicator as well. You will probably need to use other methods such as price action to determine the best momentum in the price of a security. Price action trading strategy with smoothed HEIKEN ASHI indicator. The HEIKEN ASHI smoothed indicator is really an indicator designed as a standalone trading system, but in order to improve the performance of the indicator, we're going to add the 200-period exponential moving average because the 200-period EMA is considered to represent one of the most trusted moving averages. Going forward, we're going to lay down an effective price action trading strategy using the HEIKEN ASHI smoothed indicator in combination with the 200-period EMA. In this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Trading rules. Only buy above the 200-period EMA once you have two HEIKEN ASHI candles pointing to the upside. Conversely, we're going to sell only below the 200-period EMA once we have two HEIKEN ASHI candles pointing to the downside. Please ensure you fully test the rules so you can do them without thinking. Selling rules, or short position. Rule number 1. 20-period smooth HEIKEN ASHI crosses the 200-period exponential moving averages to the downside. Rule number 2. Wait for price to rally back to the 20-period smoothed HEIKEN ASHI. Rule number 3. Wait for an obvious price action confirmation, sell signal or setup to form in the market. Once you enter the trade, you can set an initial stop loss above the previous smoothed HEIKEN ASHI candle. Buying rules, or long position. Rule number 1. 20-period smooth HEIKEN ASHI crosses the 200-period exponential moving averages to the upside. Rule number 2. Wait for price to rally back to the 20-period smoothed HEIKEN ASHI. Rule number 3. Wait for an obvious price action confirmation, buy signal or setup to form in the market. Risk-reward ratio. In many cases, market strategists find the ideal risk-reward ratio for their investments to be approximately 1 to 3, or 3 units of expected return for every 1 unit of additional risk. Here are other examples of the HEIKEN ASHI smooth price action trading strategy to fully understand this wonderful strategy and to make the most out of it. Technically speaking, you can use this indicator for all time frames. However, the shorter the time frame, you will see more fluctuation and possibly more whipsaw, which may cause small losses that can eat up your portfolio quickly. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.